Hey, welcome back to The Dive. Today on the show, we have the CEO of GraniteShares, Will Rhind. He's here today to answer some of our questions about interest rates, Joe Biden's proposed tax on billionaires, oil prices, Tesla's recent price cuts, his look on the relationship between the US and China, the price action of gold, and be sure to stick around till the end to hear about GraniteShares' new ETF. Hey, Will, welcome back to The Dive. Thank you so much for joining us today.
Yeah, thank you so much. Good to be on again.
Okay, so let's start off with this. Jerome Powell opened the door for a 50 basis point rate hike at the upcoming March FOMC meeting. Do you think that high interest rates are here to stay?
I think higher interest rates are probably here to stay, meaning that the period of the last 10 years was somewhat of an anomaly in terms of the low interest rate environment that we had. I don't think that we're necessarily going to see interest rates much higher than where we are today, but that is in percentage terms, like a huge change to where we've come from. So I do think that we'll have an environment of higher interest rates, but I think there's still room for that to come down a little bit from where we are if there's a recession.
President Joe Biden is proposing a 25% minimum tax on billionaires, nearly doubling capital gains tax and quadrupling the 1% stock buyback tax. Do you think that this will have an impact on the market?
Not at all. I think it's purely political and, really probably a question whether it will even see the light of day in terms of an actual law. But I think it's probably more just political posturing at this stage.
Oil prices have been falling since the summer of last year. What do you think is driving the price of oil down?
A couple of reasons. Probably the biggest one is there's still huge recession narrative that really overtook the market. I'd say in the 6 months, certainly of last year. It's been dissipated a little bit so far this year, but I still think that the vast majority of sentiment is still negative, and that's affecting the oil price in particular. I think also, China's reopening was supposed to be, a big supporting factor for the oil price. It certainly was initially when China opened up. But I think, again, we're seeing some signs that the growth may not be there in perhaps the way that some market participants hoped towards the beginning of the year. So maybe a couple of things weighing on oil at the moment. But I think the most important one probably is a recessionary narrative.
Now, Tesla recently announced 4 to 9% price cuts to its Model S and X. Some say that this sparks a price war with Chinese EV makers. What are your thoughts on Tesla's recent price cuts?
I think if there's a price war with Chinese EV makers, it's really a Chinese story. So in other words, it's for the vehicles that are sold inside of China, because in the US, Chinese EV makers are not really in the game. Tesla is by far and away, has a monopoly position, or at least a huge market share leadership position in the US market and most other Western markets. So I think if there's a price war going on, it's largely going to be seen in China. Looking at price reductions, here in the US, in my mind, were partly two things. I mean, one, obviously, to maintain market share or increase market share. The other thing was to take advantage, I think, of the tax credits that were put in place by some of the most recent policy initiatives here in the US to encourage people to go out and buy electric vehicles. So a thresholds on the amount those vehicles could cost, and so bringing prices down, put some of those Tesla cars within the range of people being eligible for those discounts.
There's news that Apple is reshuffling management of its international businesses to put a bigger focus on India. It seems like we read more and more headlines like this every day. What is your outlook on the relationship between China and the US?
Well, I mean, this is probably the most important question in many ways from a super macro perspective. I think the outlook is okay, but probably veering more towards negative at this stage. And while I think the countries have just so much trade between each other, and that is important, and I don't think that's going away anytime soon. Clearly, the lesson from something like Apple is companies looking to diversify their supply chains and making sure that the big lesson from 2020 was that you didn't have bottlenecks in your supply chain because of a reliance on one particular country. And so I think you're going to see more and more of that in terms of companies looking to retool their supply chains in order to perhaps bring on not just more diversified supply, but more resilient supply as well. And that may end up, in certain cases, leading to higher costs, but it will be a safer supply chain and a more reliable supply chain because of that.
Gold sentiment seems to be down from earlier in the year. What is your read in the price action of gold right now?
It's purely about the increased expectations of, first of all, more interest rate hikes, which has really overtaken the narrative in the last few weeks. And obviously, what comes with that is a stronger dollar as rates are rising, rates expected to rise, and then higher real interest rates. So it's really the cocktail of those two things, or three things, that is putting a bit of a negative sentiment on gold. Remember that gold performed really well in the back half of last year when the opposite effect was happening. The dollar had peaked in about August of last year, and expectations of interest rates were really skewed to the downside. And so from that perspective, gold had a great last 6 months. But since the beginning of the year, some of those inflation numbers have popped back into the narrative higher than people expected. The job numbers here in the US have come in higher than expected. And so it just helps this narrative, which is unfortunate for gold in the short term, which is that interest rates will move higher and the dollar move higher.
Okay, so lastly, before we let you go here, Will, are there any specific ETFs that you wanted to highlight for our viewers?
Yeah, I think one ETF that is worth a mention is our ETF HIPS or HIPS. This ETF is a high income ETF, so pays at the moment around 10% yield per annum, which is, in this current environment, one of the few places you can get an above inflation return or above inflation yield. And this ETF invests in a sector called pass-through securities. And pass-through securities, as the name might sound, literally pass substantially all of their income on to shareholders, and they don't pay corporation tax. So these are things like MLPs, master limited partnerships, which engage or own energy infrastructure like oil and gas pipelines. You have REITs, which most people know, both in the equity REIT sector and the mortgage REIT sector. Closed-end funds. So closed-end funds typically employing a number of different strategies, but more in the fixed income space. And then lastly, you have BDCs or business development companies, which tend to be more lending or financing type entities for small to mid-sized companies. So it's a diversified portfolio of those different securities that gives a very high level of income, and that's paid on a monthly basis. So you get a monthly fixed distribution of 10.75 cents per share. So interesting ETF to look at for anybody who's looking for income in the portfolio.
Okay, great. Well, thank you so much for joining us today, Will, and sharing some of your expertise with us and our viewers. We really appreciate it.
No problem. Thank you so much for having me. Pleasure.
To our audience at home, thank you so much for tuning in today. We will be back again tomorrow, so please stay tuned by hitting that notification bell and subscribing below before you leave us. Bye.